Over the last 52 years, the price of silver has achieved a specific feat on merely two occasions, in 1974, again in 1979, and now in January of 2026. What I am preparing to reveal has occurred only twice in contemporary financial history. Comprehending the events that followed those two prior instances could very well distinguish between securing profits that alter your life and suffering losses that devastate it. On both of those previous occasions, silver executed something dramatic in the subsequent months. One instance forged wealth that lasted for generations. The other instance ensnared investors in a frustrating hold for half a decade. Identical initial conditions, yet entirely divergent results. At this very moment in January 2026, we are observing the third such occurrence develop in real time. The vast majority of people are utterly unaware this is taking place. Most market commentators are not discussing it. The bulk of investors remain completely in the dark regarding what this pattern signifies. However, by the conclusion of this presentation, you will possess a clear understanding of precisely what silver is demonstrating. You will learn what transpired following the two prior episodes, and you will be equipped to formulate a reasoned judgment concerning what may follow. The reality is this: the upcoming 60 days have the potential to establish the trajectory of the silver market for the next 10 years. Therefore, focus closely. This may constitute the most crucial silver market examination you view all year. Welcome to The Hidden Economy. If you are a new viewer here, my channel is dedicated to deconstructing intricate market patterns into concepts that are genuinely understandable. No sensationalism, no empty jargon, just actionable data, historical context, and practical analysis. Please subscribe immediately and activate the notification bell because the follow-up content to this video will be absolutely essential. If you derive value from this breakdown, please support the video by pressing the like button. It assists the channel more than you might realize. Now allow me to demonstrate what is occurring. Silver has just performed an extraordinary feat. In January 2026, silver appreciated by 65% in a single calendar month. A 65% monthly gain undoubtedly sounds remarkable, and it is. Yet, here is what renders this moment genuinely historic. During the past 52 years, silver has only posted a 65% monthly gain on two other occasions, in December of 1979 and February of 1974. That is the complete list. Twice in over 5 decades. And now we have witnessed the third instance. Silver has surged 270% in this past year alone. This is not standard. This is not routine market activity. This is what market technicians term a parabolic advance. Let me clarify what a parabolic move truly signifies, as grasping this concept is vital for anticipating subsequent action. A parabolic move manifests when a price chart ascends nearly vertically. Rather than exhibiting ordinary fluctuations with ups and downs, the chart begins to resemble a rocket ship at liftoff. There are no substantial retracements, no periods of sideways consolidation, just inexhaustible buying pressure driving the price ever higher. The chart line literally curves upward in the shape of a parabola, which is the origin of the term. It is crucial to understand the dual nature of these parabolic advances. They are exhilarating. They generate enormous fortunes for individuals who entered early. They dominate financial headlines. They induce intense fear of missing out. Suddenly, everyone is discussing the asset. However, they are also perilous, exceptionally perilous, because parabolic moves are inherently unsustainable. They cannot continue indefinitely. Eventually, the music ceases. And when it stops, it typically halts with violent suddenness. This is precisely why examining the aftermath of the two prior instances is so critical. History provides us with a clear blueprint of what can potentially occur next. Let us journey back to December of 1979. This represents one of the most captivating chapters in precious metals history, and fully comprehending it is indispensable for interpreting our current experience. The preconditions were strikingly analogous to what we are observing today. Silver had been undergoing a powerful rally for months. The Hunt brothers, two billionaire entrepreneurs from Texas, were amassing colossal positions. They were convinced silver was profoundly undervalued. They purchased virtually every ounce they could acquire. Inflation was running rampant throughout the United States, reaching double-digit percentages. Citizens watched their purchasing power rapidly deteriorate. The US dollar was under severe pressure. Confidence in the financial architecture was eroding. In December of 1979, silver achieved a gain of exactly 65% for the month. Does this sound familiar? It should, because an identical event has just transpired in January 2026. The chart went parabolic, shooting straight upward. Each trading session established a new peak. The mainstream financial media began covering silver incessantly. It featured on magazine covers, news broadcasters discussed it constantly, even casual acquaintances started talking about silver. Universal bullish sentiment prevailed. Everyone believed the price would climb further. A pervasive sense emerged that the traditional rules of the market were no longer applicable. Predictions of silver reaching $100, even $200 were commonplace. The potential seemed limitless. Now, I anticipate some viewers are thinking, that was the Hunt brothers' manipulation. That situation was unique. The present circumstances are different. I acknowledge that perspective. The specific circumstances, the key participants, and the market scale were indeed distinct. However, this is the essential point. Financial markets often echo historical data. They have always done so, and they always will. Patterns recur because the underlying psychology of market participants does not evolve. The emotion of greed in 1979 is identical to greed in 2026. Fear feels the same. The anxiety of missing out feels the same. The superficial details may change, but the fundamental behavioral pattern persists. So, what occurred after December 1979? January 1980 arrived. This is where the narrative becomes intensely instructive. After its 65% December surge, silver did not pause. It continued to ascend explosively. January 1980 delivered an additional 35 to 40% gain on top of the previous month's rally. Silver reached its zenith at approximately $50 per ounce on January 21, 1980. That date marked the absolute peak. Contemplate that for a moment. 65% in December, followed by another 35 to 40% in January. Consecutive months of breathtaking gains. And then it imploded. Not a standard correction, but a total and utter collapse. In the ensuing weeks and months, silver plummeted dramatically. It was one of the most brutal commodity corrections in history. The velocity of the decline was staggering. Investors who purchased near the peak did not merely incur losses, many were completely obliterated. Traders using excessive leverage faced margin calls they could not satisfy. Fortunes painstakingly built over years dissolved in a matter of days. The crash was so catastrophic that governmental regulators were compelled to intervene, altering the rules governing commodities trading. The Hunt brothers ultimately faced bankruptcy. This episode became one of the most meticulously studied market events ever recorded. Here is an additional, profoundly significant detail that many fail to fully appreciate: that $50 high from January 1980 remained the all-time record price for 45 consecutive years. 45 years, nearly half a century. Some observers will correctly note that the price technically approached this level in 2011, reaching about $49. Yet it failed to surpass it. The reason is that $50 had transcended a mere price point. It had become a structural resistance zone, a psychological barrier seared into the collective memory of the market. Everyone recalled 1980. Everyone remembered the crash. Everyone remembered the financial pain. That structural resistance proved so potent that it required another 14 years after the 2011 attempt for silver to finally achieve a decisive breakout. 14 years of consistent rejection at that level. It has only been breached recently within the context of the present rally. We are now trading above that historic threshold for the first time in 45 years. That, therefore, is potential outcome number one, the 1979 scenario. A 65% monthly gain in December, followed by another 35 to 40% gain in January. Peak euphoria at the top with universal bullishness, culminating in a devastating crash that established a multi-decade ceiling. Now let us apply this framework to the present. If January 2026 is analogous to December 1979, then we have just completed our 65% month. If February 2026 then mirrors January 1980, we could witness another 35 to 40% gain during this current month. Let us perform the calculation together. Silver is currently fluctuating near $110 following recent volatility. A further 35 to 40% rally from this level would place silver approximately between $150 and $160, $150 to $160. This is not a speculative figure plucked from the air. It is the direct mathematical projection if this specific historical pattern repeats. At those elevated levels, monthly momentum indicators like the RSI would be screamingly overbought. Sentiment surveys would likely reflect maximum euphoria. Predictions for $200 or $300 silver would become commonplace, and historically, that precise environment is where significant market tops frequently form, when everyone is bullish, when the possibility of declining prices seems inconceivable, and when purchasing appears to be the most obvious and effortless decision in the world. If we reach the $150 to $160 zone, I believe that represents the critical area for vigilant observation. That could signal the culmination of this specific parabolic phase, not necessarily the ultimate peak of the entire long-term bull market, but the top of this explosive leg, a peak from which recovery could require years, precisely as it did after 1980. Now, allow me to present the second historical scenario, as it is equally vital to comprehend and offers a wholly different result. We turn to February of 1974. The macroeconomic backdrop shared some similarities. Silver was in a robust bull market, inflation anxieties were mounting, and the US dollar faced pressure following President Nixon's termination of the gold standard in 1971. In February 1974, silver gained 65% in a single month, the exact same percentage witnessed in December 1979, and again in January 2026. Market participants universally anticipated continued upward momentum. Everyone believed silver was destined for exponential gains. The technical setup appeared virtually identical to what would later unfold in 1979. Yet the subsequent development was completely dissimilar. There was no follow-through month with 35 to 40% gains. There was no dramatic blow-off top. There was no spectacular crash. Instead, a more psychologically testing phenomenon occurred. Silver entered an extended grinding consolidation phase. For the subsequent 5 years, silver essentially moved sideways, trapped within a broad trading range. It would rise modestly, then decline modestly, never achieving meaningfully new highs, never delivering the continued surge everyone anticipated. 5 entire years of stagnation. Reflect on that. 5 years of frustration. 5 years of choppy, directionless price action. 5 years of witnessing other asset classes appreciate while one's silver investment remained dormant. Multitudes of investors capitulated during this protracted period. They liquidated their positions out of sheer boredom, frustration, financial necessity, or a loss of faith that silver would ever advance again. The financial media diverted its attention away from silver. The initial excitement dissipated. The public moved on to other investment narratives. Silver became a forgotten, boring asset. Then, in the latter part of the 1970s, silver finally erupted from that prolonged consolidation, and when it broke out, it ascended in the same violently parabolic manner previously described. That powerful breakout ultimately catalyzed the 1979-1980 blow-off top we just analyzed. Therefore, the investors who maintained the discipline to hold through 5 years of stagnation were eventually rewarded on a massive scale. But doing so required a degree of patience that most people do not naturally possess. It required unwavering conviction in the absence of any positive price reinforcement. It required steadfastly holding an asset when nearly everyone else had abandoned it. Same initial setup. A 65% monthly gain. Completely different outcome. One path led directly to an immediate blow-off top and a devastating crash. The other path led to 5 years of consolidation before an eventual, powerful ascent. This duality is what renders the current moment so exceptionally fascinating and critically important. We have observed this precise setup on 2 prior occasions in modern history, and each time the result was dramatically different. Consider the implications for you as an investor. You are positioned at a financial crossroads that has materialized only twice in the past half-century. The decisions you implement in the coming weeks could very well determine your investment outcomes for years into the future. Most market participants are completely oblivious to this historical juncture. They are merely reacting to daily price fluctuations, driven by emotion, making impulsive decisions. They lack any awareness of the historical significance unfolding around them. But now you possess that context. You understand the 2 distinct possibilities. So which scenario will we experience, the 1979 outcome or the 1974 outcome? This is the pivotal question. Literally, your answer to this query and how you structure your portfolio accordingly could be worth a fortune. Let me share my analytical perspective. I believe the current evidence suggests a higher probability of the 1979 outcome relative to the 1974 outcome. My reasoning is as follows. The sheer velocity and intensity of this current move bear greater resemblance to 1979. The scale of retail investor participation appears more analogous to 1979. The macroeconomic backdrop, characterized by persistent inflation concerns and US dollar vulnerability, also aligns more closely with the 1979 environment. However, I must emphasize that I could be mistaken. Financial markets possess a notorious capacity to humble every analyst who believes they have deciphered their next move. Where I hold confidence is in this observation. If silver prices break decisively above the recent high near $121 and establish sustained new highs, the probability of a major market top forming in the $140 to $160 zone increases substantially. That is the specific price band I am monitoring. If we ascend into the $140 to $160 range, I consider that a prime opportunity to secure partial profits, not to liquidate an entire position, but to prudently reduce risk exposure, lock in a portion of gains, and build a defensive buffer against the potential severe correction that historically follows blow-off tops. This is the critical element most individuals overlook during parabolic advances. They feel extraordinarily pleasurable in real time. Prices are rising daily. Portfolio values are increasing. It creates an illusion of perpetual motion, making the act of selling appear foolish. Why exit a winning trade? Yet that perception is precisely the trap. The prevailing euphoria obscures the monumental risk building beneath the surface. When the inevitable reversal commences, it often occurs with such ferocious speed that reactive selling becomes impossible. By the time an investor recognizes the danger, a substantial portion of their paper gains has already evaporated. The individuals who purchased at $50 in January 1980 were convinced of their financial genius. They were certain silver was destined for $100 or $200. They had no conception they were purchasing the absolute peak of a 45-year cycle. Do not allow yourself to become that investor. Now let us examine the converse perspective, the downside risk. What if my analysis is incorrect, or if the market experiences a sharp correction independent of a blow-off top? In the 1974 scenario, a price floor was established at considerably lower levels. If we enter a multi-year consolidation phase, we must contemplate where potential support might reside. Based on contemporary market structure and historical precedent, I estimate a worst-case floor for silver to be approximately $60 per ounce. This would represent the ultimate accumulation zone, a level where disciplined capital would likely enter in preparation for the next major bullish cycle. I must be unequivocally clear on this next point. Dismiss any expectation of seeing silver at $30 or $40 again. Those price points belong to a bygone era. They are not returning. The fundamental floor for this market has been permanently elevated. Even under the most pessimistic forecast, even if every variable turns negative, I do not foresee silver declining below $70. That level now constitutes the new structural support foundation. This is invaluable intelligence for anyone considering accumulating silver. You now possess an approximate strategic range, upside potential to $140 or $160, downside risk to approximately $70 in a severe bear case. This defined risk-reward ratio provides a practical framework for decision-making. Permit me to address the psychological dimension of our current experience, as understanding market sentiment may be more crucial than analyzing any specific price level. Present conditions are defined by extreme volatility. We have witnessed multiple trading sessions with 10 to 15% intraday swings. Recent activity featured a massive sell-off, a partial recovery, and then another steep decline. This volatility is not an aberration. It is an intrinsic characteristic of parabolic price movements. When an asset appreciates this rapidly, violent corrections are inevitable. Large institutional players are selling into strength. Retail traders are chasing prices near peaks. Over-leveraged positions are being liquidated. Stop-loss orders are being triggered en masse. These actions create cascading effects. One wave of liquidations triggers the next. Panic selling begets further panic selling. This is the typical cycle that erodes the capital of most retail investors during such periods. They purchase when prices are soaring, driven by fear of missing out. Then prices crash, triggering panic and a sale at the bottom. Prices then recover to new highs, prompting another purchase near the top. The cycle then repeats. Buy high, sell low. Buy high, sell low again. This pattern continues until an account is depleted. This is the immutable mechanism through which wealth is systematically transferred from emotional, reactive investors to patient, strategic ones. Your fear provides the fuel for market rallies. Your greed supplies the catalyst for their collapse. I urge you to deeply internalize that statement. Please read it once more and reflect on its truth. When you are gripped by fear and sell, you create a buying opportunity for sophisticated capital. When you are consumed by greed and buy at elevated prices, you provide the exit liquidity that smart money requires to profit. You, the emotional participant, are the product. Your psychological reactions are being systematically harvested for gain. The sole method to escape this cycle is to formulate a definitive investment plan before volatility strikes. You must predetermine your actions under various scenarios. Identify your strategic accumulation levels. Establish your profit-taking zones. Understand your personal tolerance for volatility to avoid making impulsive, emotionally driven decisions. Without a plan, you will inevitably become the exit liquidity for those who possess one. Allow me to offer some practical guidance, synthesized from our entire discussion. If you are a holder of physical silver, adopt a long-term perspective. Physical metal is not a short-term trading vehicle. It is a decades-long vehicle for wealth preservation. Daily or weekly volatility should be largely irrelevant to your thesis. Whether the immediate future mirrors 1979 or 1974, disciplined physical holders will likely prosper over the extended horizon, though it may require significant patience. If you are actively trading silver, recognize that this is among the most hazardous environments. Extreme volatility will annihilate trading accounts. Leveraged positions face extreme risk of being wiped out. If you cannot endure 30 to 40% portfolio drawdowns without panic selling or facing margin calls, you should not be trading this market in its current state. If you are seeking to realize profits, the $140 to $160 zone is where I would initiate a gradual scaling out process. Remove a portion of capital from the table, protect the gains you have accrued. You can always re-enter at lower price points if a substantial correction materializes. If you are looking to establish a new buying position, exercise extreme patience. If the 1979 scenario unfolds, a severe crash will follow the eventual top. If the 1974 scenario prevails, a prolonged consolidation will present superior entry points. In either case, chasing the price at current elevated levels is inherently risky. If you have no existing position and are uncertain how to proceed, begin with a very small, manageable allocation. Do not deploy your entire capital reserve at these levels. Commit to a strategy of gradual accumulation, such as dollar cost averaging over time. Do not allow the fear of missing out to dictate your investment actions. At this moment, there are three categories of individuals watching this presentation. 1. The first group will absorb this information and take no actionable steps. They will find it interesting, close the video, and return to obsessively checking price quotes every few minutes. They will succumb to emotion at the most inopportune times. They will buy at peaks and sell at troughs. Eventually, they may abandon silver entirely, missing its long-term appreciation. 2. The second group will become overwhelmed by the complexity. The abundance of information, the dual historical scenarios, the potential for an entirely different outcome. It will induce paralysis. Unable to decide on a course of action, hindered by overanalysis, they will remain on the sidelines, watching market movements they cannot participate in. 3. The third group will utilize this information as the foundation for a robust personal investment plan. They will internalize the two primary historical outcomes. They will identify the key price levels requiring vigilance. They will predetermine their actions if silver rallies to $160. They will have a strategy prepared if it corrects to $70. They will not be surprised by market events because they have already contemplated and prepared for these scenarios. Which category describes you? Let me concisely recap the core concepts we have explored today. A 65% monthly gain in silver has occurred only twice in 52 years, February 1974 and December 1979. We have just witnessed the third instance in January 2026. Following December 1979, silver rallied another 35 to 40% the next month, then crashed, establishing a top that endured for 45 years. Following February 1974, silver consolidated sideways for 5 years before eventually embarking on its next major advance. If the 1979 pattern repeats with a 35 to 40% gain in February 2026, silver could reach the $140 to $160 range. This zone should be monitored for potential reversal activity. $70 per ounce represents a probable floor in a worst-case bear scenario. The era of $30 or $40 silver is conclusively over. Now I must articulate a vital disclaimer with absolute clarity. Attempting to predict precise market tops during powerful uptrends is among the most difficult endeavors in trading. I need you to understand this profoundly. No one knows where the top will be. No one, not me. Not the world's most renowned analysts, not the largest global hedge funds. No entity can declare with certainty the exact price at which a rally will culminate. The market itself is the ultimate arbiter. It is indifferent to our predictions and analyses. It moves according to its own internal logic. My role is not to proclaim, this is the top, sell here. That is not my objective. I am not here to pinpoint market tops. That is the market's exclusive prerogative. My purpose is to educate, to provide context, to illuminate historical precedents, and to demonstrate what has transpired under analogous conditions. Armed with this knowledge, you can take appropriate, personalized action. You can prepare for various potentialities. You can face the future informed, making decisions based on reason rather than raw emotion. This is the fundamental reason I produce this content. Observe, the dominant players in these markets, the major institutions, the hedge funds, the so-called smart money, generate their profits by capitalizing on the predictable behavior of retail investors. They accumulate when retail is fearful. They distribute when retail is greedy. They utilize retail investor emotion as their source of exit liquidity. This dynamic has persisted for decades and will continue indefinitely. However, there is a powerful countermeasure. Retail investors can become educated. They can learn the rules of the game. They can cease being the source of liquidity and start positioning themselves on the advantageous side of major trends. This is my core motive for creating this channel, not to issue buy or sell orders, but to empower you with the understanding required to make superior independent decisions. I am committed to this mission. To reiterate the central psychological insight, your fear provides the fuel for market pumps. Your greed triggers their crashes. Do not volunteer as the individual who transfers personal wealth to patient investors by succumbing to emotional impulses. Now, I have a request for you. Please contribute to the discussion below by leaving a comment. Indicate which historical outcome you believe is more likely for the current market, 1974 or 1979. I read every comment and am sincerely interested in your perspective. Furthermore, let me know if you would like me to conduct a similarly detailed historical analysis on gold. I possess extensive historical data on gold that I believe would be tremendously valuable for your understanding. Simply type gold analysis in the comments if you wish that to be the focus of a future video. If you have not yet subscribed, you are overlooking unique content. This is the caliber of market examination you will not find elsewhere. Please subscribe, activate the notification bell, and I look forward to engaging with you in the next video. You are also welcome to join the channel membership to further support this independent work. Recall my opening statement. In the last 52 years, silver has achieved this specific milestone only twice, in 1974 and 1979, and now in January 2026. We are living through the third occurrence in real time. The developments over the coming months could very well establish the character of the silver market for the next decade. Remain informed, maintain rationality, do not delegate your financial decisions to transient emotions. This is the hidden economy because the most consequential narratives are never lying in plain sight.